Welcome to our live stream on Furry Hippo Finance, where here we're going to be answering any of your questions that you have about financial education and literacy. I'm going to go over some of the top 10 financial tips that I do kind of share with other people. I am a certified financial counselor. My name is Dennis through the state of Michigan. But overall, I see a lot of people that I do financial counseling with, and sharing the information is the reason why I actually started the YouTube channel. That way I could sit down, I could talk to you guys, we could share a lot of information, answer questions that a lot of people don't know the answers to. That way, if you have specific questions, guys, drop them in the chat. They are going to be right down there so we can see them. This is the first live stream. I don't know exactly how it's going to go. Don't know if we're actually going to get anyone in here for the live chat questions, but I wanted to go through again some of the financial tips, starting with number one, creating a budget. This is one part, guys, that people cannot overlook when it comes to outlining your income, looking at your fixed expenses, looking at your discretionary spending, looking at the needs and the wants category. This is really the allocation of funds where every dollar does have a purpose. And Kookie is here. What is going on, Kookie? Again, we're trying to get into live streams, trying to get it on a regular basis. I know you have been waiting to ask a couple questions, but like I was saying with creating a budget, guys, it really breaks down where your money is going to, and understanding and having a very strong understanding of every dollar having a purpose, and where you're spending money that you don't need to be spending your money essentially is what I see for a majority of people. Now, probably 90% of the people that I deal with on a regular basis, which we are in a very affluent area, do not have a budget. Again, probably about 90% of people have no budget. They have no idea where they're spending their money. Most of them don't even know how much money they make on a weekly basis, monthly basis, however they get paid. They don't know exactly how much money is coming in. And they also do not know where the money is going, which is kind of crazy to think that, you know, you have money coming in, you have a lot of money going out. Are you in the negative? Are you in the red? What are you using for debt repayment? For a majority of people, they just take their money and stick every extra dollar towards the debt repayment, which means the second that an emergency comes up, boom, that's right there, hit with that unknown or unanticipated expense. And they're running right back to the credit cards. They're racking them up, not only in addition to kind of what they have paid down on the cards, but also looking at the amount of money that they go above and beyond with the expense. This brings us into number two, guys, and why I really stress it is building an emergency fund. An emergency fund will keep you from overspending. It will also keep you from going right back to the credit cards when an emergency happens. That is one of the biggest caveats where a lot of individuals will start getting ahead. They'll have somewhat of a budget down, but they'll start getting ahead financially. All of a sudden, an emergency happens. They're right back in the red, meaning they're looking to borrow money. The emergency fund is there to really act as a true emergency. For a majority of people, the emergency fund that they utilize is, I didn't pay my rent because I didn't budget correctly. I had to use some money to pay my car payment because I overspent on XYZ. Guys, the emergency fund, you have to fundamentally set aside in a savings account, in a high yield savings account, making sure that you're setting this money aside for a true emergency. Now, when it comes to a fully funded emergency fund, they say 3 to 6 months is what they're looking for. Now, with that being said, the 3 and 6 months can have a huge variation. I mean, you could be talking $10, $20, $30,000 variation depending on your living expenses when it comes to building out this emergency fund. That is the big reason, guys, why when I look at someone in an individual where I say 3 months, that is individuals that have a very stable job that is not going to be going anywhere. They have, let's say, salaried positions that are not depending on hourly. Also makes a big difference, guys, depending on where they work and how essentially their job is structured. When you look at teachers, when you look at police officers, when you look at government officials, stable income, stable job, probably not going anywhere. 3 months of emergency fund would be perfect for that kind of situation. When we start looking at the 5 to 6 months, so actually having a lot more of an emergency fund, this could be hourly workers that maybe are relying on overtime. This can also be anything that is very sales orientated or really that doesn't have that set expense. What I mean by that, let's say you're a card salesman. That would make a really big difference, guys, where your sales are going to be dependent on your income. You're reliant on that. All of a sudden, we have something like a pandemic happen. All of a sudden, people are broke, people are without sales, people are without jobs, meaning that the money is not coming in, the emergency fund was not set, and then it grows right back to financing. Let's see the questions here, guys. What do you think about investing in the VOO at the moment? I am thinking about putting money in there into the VOO. So funny you should say that, Kookie. I did a video earlier today that's actually going to be out tomorrow about the S&P 500. So overall, the S&P 500, if you caught the videos, I have a majority of money that is invested in the VOO. We did rebalance it yesterday based on, or actually a couple days ago, based on the addition of the BTC ETF that was out through Grayscale. But overall, the VOO, when you look at the greats, and when you look at Warren Buffett, when you look at Charlie Munger, they always say, and they have always said, investing in the VOO is your best option as an individual investor for really two reasons. Number one, the performance. When you look at the last 15 years, and that's what I covered in the video that's coming out tomorrow, but when you look at the last 15 years of the VOO performance, you're at about 13.5 to 14% on average. Now you factor in inflation, you're at about 11.5% over the last 15 years of the VOO, which again makes it kind of crazy. So putting money into the VOO, again, I have done that for years, literally with my 401k plan and also with the what I have through M1 Finance. Absolutely, Kookie. I would invest in the VOO. Now, the big thing to really remember is when you're investing, guys, we talk about the 3 to 5 years. That is, there's going to be ups in the market. There's going to be downs in the market. And overall, looking at 2024, 25, 26, we know the Federal Reserve has kind of evened out interest rates. They said they're going to relatively stay the same, which means we could see some reductions in 24. Now, some things to think about as well is we are having an election year here in the States, which could definitely make a big difference. But overall, guys, the VOO last year, I believe, was around 24% as a return. And I don't know anywhere else that you're going to have that kind of growth in a ETF, especially because the cost ratio or the expense ratio is a 0.03. So honestly, it's almost nothing to invest in the VOO because the expense ratio is so cheap. Definitely, I would advise it. I would highly advise with the VOO. And again, personally, I have a significant amount of money. I'm talking probably 100,000 plus in the VOO, just for the fact that not only does it spread out with a very cheap cost, but you're also exposed to every single sector. That's the big thing. When you look at the 500 largest companies in that S&P 500, you have exposure to all of the different aspects, and really the risk mitigation going across every single different sector is within the VOO itself. Absolutely. Now, number three, guys, we get into the automating of the savings. Now, this again is something that I feel a lot of people have a really, really big miss on. I know I Can Teach You to Be Rich, which is a show on Netflix, or there's a lot of different ways to do it, guys. But automating savings, automating the bill payments, automating a portion of your income to go directly to your savings account, to your investment account, to everything of that nature is something, again, that I feel a lot of people miss because essentially money comes in, they spend the money, money goes out, end of the month, zero is left over, or they're running it in the red, which again, that is what I do see with a lot of individuals is when they're going through and they're actually doing, when they're figuring out their bills and kind of figuring out the budget, they're running out of money at the end of the month, which means nothing for savings, nothing for the emergency fund, and there is nothing when it comes to the debt repayment. And essentially, it creates this cycle of the paycheck to paycheck cycle. Now, we know roughly 46% of Americans are living in that paycheck to paycheck cycle, which is horrible to think that literally one paycheck away is going to make you broke. So definitely automating, even if it's $5, $10, $20, $50, whatever it is, guys, you want to save that first $1,000 up in that kind of starter emergency fund. That way you do have the ability to fall back on it in smaller expenses, smaller emergencies. You are going to have that cut through the automation process. The number four, we get into cutting unnecessary expenses. This can be really identified. And I've said this before. This is actually part of the master's program that I did when I was going to school at Walsh here in Michigan, which is a business school. They had us go through a finance class. We analyzed 90 days of statements. So we actually took 3 months of banking statements. We broke everything down into spreadsheets utilizing Excel at the time, and broke it again into kind of different buckets on your income, your needs, your wants, your expenses, kind of breaking it down into what you do have left over. Overall, guys, people were absolutely floored and shocked with how much money they were spending on a lot of unnecessary expenses. And we started this class actually coming up with 3 to 5 goals that we wanted to kind of look at and evaluate when it came to the financial literacy and when it came to the financial education. And overall, it was very interesting to see where people said, I want to save more money. I want to repay my debt. I want to invest in my 401k. Yet they were dropping a couple $100 a month at Starbucks, saying they didn't have money for one thing when the money was literally going to another part or another expense. For short term, which investment would I recommend? I have some in cash funds, which give me about 4%. Short term, that's probably the best for you, Kookie. Overall, again, if you're looking at CDs, even now, guys, with the credit union I work for, we have short-term CDs. We have 9-month CDs. We have 11-month CDs. The 9 months are 5.15. And then, of course, the 11-month CDs are 5.4%. Even looking at M1 Finance, I do have my high yield savings there. It is paying 5% at M1. I know you do have to have their upgraded membership, but overall, yes, short term. And the problem with that is, Kookie, is if you're putting some money into the VOO and you're looking kind of shorter term, I'm thinking your investment side, you're thinking shorter term. But when you think of if you're thinking shorter term, like let's say, for instance, your emergency fund, that is what you save liquid. That is what you save. I mean, if you're getting a 4% annual return on the money you have set aside for your emergency fund, that is doing very, very well. Now, when it comes to the investment, like we said, guys, a 3 to 5+ year time frame, if you're putting in the VOO, and if you're putting 10% of the savings in there, you really have two options. Either one, you could do lump sum investing, just dump that 10% of the savings right in there. Or two, you could dollar cost average it like I do. We put $1,000 in there every single Monday. So Monday, again, historically has been the best day to buy as the market kind of digests the news that is going on. But you can actually go in there and dump a bunch of money in there, or just do the dollar cost averaging. So putting the money in there. Again, make sure when it comes to the budget, Kookie, that you are sitting on your emergency fund after you've eliminated your debt. I'm assuming that if you're looking to invest, if you're saving money in cash, that your debt is paid. Now, what we mean by debt is when it comes to credit cards, when it comes to automobiles, when it comes to unsecured, everything short of the house should be paid off before you start investing. Now, I know some people say holding on debt, or even low interest debt really doesn't make sense to set aside. Now, one thing to remember is if you're paying down even lower interest debt, and this is really the logic behind it, is if you're paying down lower interest debt, you're saving X amount on your monthly payment. Once that payment's done, it is going to give you the ability to actually invest a lot more money. But in addition, guys, let's say, again, in this scenario, you're putting 10% into the VOO. 2024 might be a very bad year like we've seen in 22, where you could see a 24% reduction in what you put in there. For most people, emotionally, they could not really sit on it or really not stay with the investment. If you're seeing a 25% reduction in the investment, most people would pull out long before that, leaving those realized gains or realized losses in this case on the table. Because remember, guys, when you put your money into the VOO, you're buying X amount of those ETFs. So you're buying a certain amount of shares. The really big thing is if the market goes up, if the market goes down, your portfolio is going to fluctuate when it comes to the amount you have in there. But with that being said, in the fluctuation of the portfolio, you still own the exact same amount of shares. The only time that you're going to have a gain that is really realized or a loss that is really realized is if you go in there and you sell your asset. Essentially, when you're cashing that out, if you cash it at, a gain, if you cash it at a loss, that is the only time that you're going to get those gains or those losses is when you sell the asset. If you're holding it, like I said, investing 3 to 5+ years, you're going to take a long time to see the gains. And historically, over the last 15 years, we have 2 years that were actually down in the last 15, which is awesome. Thank you for the answers. I have zero debt for now. That is awesome. Really interested in knowing your thought on Robert Kiyosaki's 1 billion. So the thing is, Kookie, is when you think of like Robert Kiyosaki with the $1 billion in debt, it depends how you play it. Now again, when you look, so $1 billion in debt, you're taking it on a different scale, honestly, at that point, because I believe he owns thousands, if not tens of thousands of rental properties. So even though, the money coming in relationship to the money that is going out, especially with buying the debt, it's a way to do it. It is a very, very costly way to do it, because if you think about that, not only is he borrowing, so he borrows $1 billion in debt, he is paying interest on that $1 billion of debt to purchase those houses to generate income. Yes, a lot of people have done it that way and have been very financially successful doing it that way. However, a lot of people have been absolutely devastated financially because they're not at that level where they don't negotiate, or they don't properly utilize the debt, or they don't have enough money coming in to cover the debt, where then you start liquidating assets, you start liquidating a bunch of different things. There's not many people that are on really Robert's level when it comes to the debt, but essentially, guys, the bill comes due. That is it. Even if it is him paying the $1 billion in debt back, even if it is his heirs or whoever, is going to take over his fortune, his company, everything else he's built, somebody is going to pay the debt, and someone is going to eventually pay the debt. And for most people, it gets to a point where having enough debt, people will not borrow to you anymore. And again, if you have an absolute absorbent amount of income, if I'm making, okay, let's say I'm making $3.5 billion a year, having $1 billion in debt doesn't seem that bad. If you're pulling in, 3.2 billion a year, that's kind of the offset that you have to be looking at. Even though he does have debt out there, he does have probably, I would say, 3 to 5, maybe even 10 times more assets in portfolios in cryptocurrency, which I don't think Robert Kiyosaki does cryptocurrency. I could be wrong on that. But overall, guys, I know a lot of people that do the debt game and kind of play that, but they always have, again, 5 to 10x assets on the other side, where if anything should happen, he could liquidate a bunch of things, pay off the $1 billion in debt, and be completely done with it. All right, guys. So getting back to the rest of our financial tips, which number 6 is one of my favorite, which is cooking from home. My wife and I do meal prep. Meal prepping is super, super convenient. I went out shopping in the morning yesterday. I picked up everything we needed. We made 4 days of meals. That is right. 4 days of meal prep. It is bought. It is paid for. It is ready to go. And then when we get home, if it's a late night or anything of that nature, when we do get home, guys, the meals are already ready. Very easy to warm up, very easy to prep to get ready. And we're not overspending. We're not going back to the store to buy additional things. We are not going out to eat. When you look at the cost really of going out to eat, guys, we went to Coney Island, which I believe was about 3 weeks ago now, 4 people to get Coney dogs and French fries. Didn't get anything else, $54. That is right, guys, $54 to get Coney's and French fries. And again, the food bills are getting exponentially, especially when it comes to restaurants, out of hand, in my opinion. Cooking at home not only saves you a lot of money, but you really know what is going into your food. You know the quality that you're buying, and also you can make much healthier and easier decisions, in my opinion, when it comes to cooking at home. Now, number 7, guys, we get into limiting the credit card usage. A lot of people are not going to like this at all, but a majority of people, as a nation, we are carrying about $7,000 in debt per individual on credit cards. Now, when you look at that and you're talking, 22% as an average interest rate on that $7,000, you're paying and you're working. And this is the way that I kind of put it in perspective that changed the whole debt cycle, just like Kookie, that is completely debt free at the moment. But it changed my whole entire outlook when I looked at the amount that I was paying in credit card debt, but not even just the credit card debt, but the interest charges. When you think of credit cards, you're paying interest on credit cards, interest on loans, interest on your home, you're paying interest on your auto loans. Everything is eating away your paycheck. So let's say in the course of a month, you're paying and being on the generous low side, $300, a month in interest. How many hours do you have to work just to cover the cost of interest for stuff that you own or even things that you bought in the past? When I see individuals with $30,000, $40,000, $50,000 in credit card debt, guys, it is crippling when it comes to your finances, living financial free, getting on the debt-free journey, but being able to save money and honestly being on the other side of the fence when financial institutions, when you can invest, but when financial institutions are giving you the 4%, like what Kookie said, but giving you that 4% back versus you paying the 22% from them, even thinking of the difference between those two guys, if you have a credit card for 22% and they're only giving you 4%, that 18% is where they're making all of their money. And the reason why credit card companies are billions and billions and billions of dollars of revenue every single year, because they're taking it from you and you're putting in hard work hours every single day just to pay the interest that goes on those cards. And when it comes to rewards programs, guys, I do not buy into them really at all. The rewards programs, someone is paying for those. In addition, when it comes to credit card rewards, overall, you're paying, and if you carry any balance at all, guys, you are paying for the rewards that you have, and there's no beneficial really thought behind that. And even if you're paying your balance off in full every single month, not paying interest, getting the rewards, you have to spend an exorbitant amount of money to actually get the rewards to really have any benefit. You're getting $5 here, $20 there, $30 here. Maybe the intro was pretty good, but that's about all that people really use. And what's going on? We got G-Star here. If you have real estate investments, how much cash reserves should you keep to help mitigate against bad tenants, damage, and vacancies? Honestly, when it comes to real estate investing, cash reserves, it depends on really where you're at. So G-Star, and again, this is kind of looking if you're in the Detroit area versus New York versus Texas versus, if you're down in Tennessee, depending where you are, definitely keeping a healthy cash reserve in there. And again, it depends a lot of where you are. We actually have a neighbor here that does rental properties. He actually does it in a couple different places. Usually also depending on the value is keeping about 10%. I know that's kind of a general rule that I've seen before, but keeping cash reserves or at least access to cash reserves, making sure, because I know some bad tenants. And again, you hear the horror stories when it comes to real estate investment, when it comes to a lot of different properties where they can't get the tenants out or, the tenant damages the place. They're going after legally for them, or they can't evict them. We've seen 6 months, we've seen 12 months where they can't get rid of a very bad tenant. So making sure that you have enough cash reserves to cover those expenses. And again, this is also going to make a big difference for you, G-Star, is if you're doing, let's say, the Robert Kiyosaki approach, where you're financing everything and you are doing, the 15 or the 30 year, or are you doing the Dave Ramsey approach where he buys all of his investment properties, which he has over 10,000 for cash. So literally there are no mortgages attached to those investment properties, because instead of going in there and financing the investment property, he is paying cash for them. And again, that is going to make a big difference when it comes to the cash reserves you're keeping on hand. Because essentially, let's say, again, you have a bad tenant that is not paying the mortgage or not paying the rent, and it's going to take you 6 months to evict them. You're going to have to float that mortgage yourself for 6 months. So let's say, again, you're paying $1,000 a month. Right there is $6,000 you're going to have to float. If it is $1,000 a month, then you add in the possible court costs, which would be probably about $2,000. So you're already about $8,000 of cash reserves in. Then if you have anything else, you're probably looking at 10 to 12,000 just to get them out of there. And if it's a bad tenant, or again, they damage the property, they won't leave the property, or when they do leave the property, you're not getting anything out of it. And if you try to prosecute them, chances are they don't have any money, couldn't maybe not have a job. That's the reason they didn't pay the rent. So essentially, you're going after someone who doesn't have any money to pay it anyways. Yeah, it again, G Star, that's I love the question, but it's very, very hard depending again how you purchase the property, and how much you have kind of tied up in the property and what is the value of the property. I mean, even here we have Detroit, which is just south of us. They can get properties for $10,000, $20,000, fixer uppers, renovators, that a lot of people do go ahead and buy those to fix them up and rent them out. But we also have properties that are rentals out here for the 250,000 plus mark, with some of the condos out here being $300,000, $400,000, $500,000 for a condo. That is right. And they are rentals. So again, depending on how you purchase it, usually about 10% is a general rule that I've seen before within the real estate investing. So continuing on, guys, if you got any questions, definitely pop them in here. But a few more financial tips here to really get into. Once we talked about, again, the credit card usage, guys, credit cards are probably the most evil thing that I've probably seen, just because they put people in such a very, very bad scenario when it comes to financial counseling and when it comes to education, with the interest that they charge, the late fees, the overall rewards programs that they kind of lure people in. I do not like them at all. But getting into number 8, negotiating your bills. This is one we did, and this is one my wife and I did incredibly well, guys. Looking at your cable, your internet, your auto insurance, even your mortgage rates, your auto loan rates. Most of the time, with the competitive nature of things that we have today, you can get cheaper bills elsewhere. We actually cut the cord, so we got rid of our cable, saved us $180 a month, went to a lower internet plan, saved us another $20 a month. That's $200 off the top. Auto insurance and homeowners was with USAA. We moved that over to AAA. That saved us $1,600 a year. So, I mean, when you look entirely, guys, you're talking right there is almost a $4,000 savings, literally keeping pretty much the same that we had. Even the insurance, when we changed over our insurance, we're now with AAA. But we had apples to apples. So they matched the exact identical policy that we did have with USAA. Moving it over to AAA, we saved $1,600 a year, which is kind of crazy. Then we get into number 9, guys, which we've talked about here, investing wisely. That is right, guys. Knowing your financial goals, coming up with your financial plans, diversifying your investment. Like I said, the VOO, that is a place, guys, where literally if you just invest in the VOO, because of how cheap it is with the expense ratio, long-term, you're going to build wealth. You're going to build wealth, and you've seen it on the channel. Every single week, we've done an update of where the financial or our investment portfolio is at. So far, we've gained about $11,000 in 2 years. So, I mean, you're talking $5,500 a year for the last 2 years with what we're putting in there. And we're starting to also see the compounding where this year, or in 2023, I got over $1,000, almost $1,100 in dividends. Going forward, the dividends usually increase, guys. So if I get a little over $1,100 every year, on top of that, buying more investments as we continue to invest, long-term strategy, we're doing this for at least the next 6 years is the plan that I want to do. And we are really looking to not only pay off our mortgage, which we have about 2 more years left, we will be 100% debt-free, including our mortgage, which means we can pump an incredible amount of money into the investment accounts and really build them up, build up the HSA. This year, I will be maxing and capping out that HSA, but also building up that investment portfolio, maximizing the 401ks. My wife actually maxes out the 401k. I put in my 15%. So we have a lot of money that is going in there to really build it long-term. And the final one in here, guys, is staying informed. That is right. Staying on top of financial matters, interest rates, investment opportunities, looking for personal financial tips, financial counselors like myself, empowers you to make decisions about your money. This is really the place where I feel a lot of people miss the boat, guys. I see individuals that go to TikTok, that are on YouTube, that are on Instagram, that are on a bunch of social media platforms. yet they know anything and they're not doing any research at all for financial matters or really betterment of themselves. In my opinion, guys, really taking the time to figure out exactly what they want to do, what their financial plan looks like, where they're investing, is it the best option? A lot of people do not invest in themselves, which I really, before you start investing, guys, what is really 2 or 3 things that you could get into that would improve yourself. Doesn't mean being better at work. Doesn't mean being better with YouTube content creation. Doesn't mean picking up a side hustle so you can actually pay down your debt, eliminating your debt, giving you the debt-free journey, or actually empowering you to invest going forward in the future. When an emergency comes up, you have the money to cover it. When you need a new car, you know what? You don't have to finance it. You don't have to pay the extra $3, $5, $10,000 to finance your vehicle because you have money set aside. You can go ahead and just pay for that car, being done with it, not worried about your credit score, but making sure that you have it and knowing financially exactly where you are. So guys, that is going to do it for this live stream. Again, we want to get into this. Didn't know exactly how it was going to work with the setup because we're not doing it through Streamlabs. I actually just did straight from the webcam and the microphone that we have here. So we're probably going to have to tweak this a little bit and adjust it a little bit. But let me know in the comments, guys, what you guys think. I'm definitely going to have it. And thank you, Kookie and G-Star, for joining us. Again, we're going to be doing this, and I want to get it on more of a regular basis. I love having the ability to come in here, talk to you guys just like we do with AFK Arena, but being able to talk to you guys about any questions you have when it comes to the financial literacy, going through some scenarios, guys, as we continue this journey. So again, that's going to do it for our live stream. Let me know what you guys think. And as always, thank you guys for watching.